Okay, I'm running the research activities of Catella out of Frankfurt/Sweden, so I'd like to give you, in a nutshell, an overview on the German situation right now, which is, well, of course, a hot topic within the last years. I'm starting with the general view on that, and I think this is maybe to explain what you see here is the available capital for real estate investments in total. So this is the sum of all the activities from fundraisers, business development people in Europe in total for all the funds. This is an enormous amount of money, 7 billion in total. Now you see that there is obviously a mismatch between the invested and the collected money. Anyway, I'd like to mention this, that you see here our forecast span of this year. We expect from the European transaction volume, and this is also important to see this, it's office, retail, industrial, hotel and resi, so all in. We expect that this will be at the range of between 219 and 32. We reduce it by 10% after the June event in London. But anyway, I think we are still optimistic that we will see a kind of an increase compared to last year. Just to mention this again, this is really the broadest picture ever. Coming now more in detail on the GDP expectations in Germany, and you know there was a little election last Sunday in the northern part of Germany. Never heard before. Mecklenburg-Vorpommern area. I don't know how to spell it. And a lot of these experts announced on Monday this will be the dawn of Miss Merkel, and this will be the end of Miss Merkel's chancellorship. Anyway, seeing just the figures we're looking for, it's a fantastic environment, and these days for the Germans, it was a fantastic environment the last 5 years. So it's all coming up, consumer spending coming up, GDP growth. It's positive, let's say this, and especially if you look compared to the rest of what we called EU 28 or 20 or 15, you see that the Germans obviously it's a cool situation on one hand. On the other hand, you know that we have around 72 different locations in Germany, and this is quite different to the rest of Europe. A little commercial on that. This is a famous Catella map, and you see a lot of dots here. So, you know it. We don't have any dominant center. But most of the people I talked the last 2 years, they love Berlin. Yes, they love Berlin, and the people from Berlin, they announced, Thomas, this is so nuts here. The prices get higher for around 40% in total. And the people from Helsinki, from Great Britain, or wherever they come, and so, Thomas, it's so cheap compared to London, Helsinki, and Stockholm. So this is, again, it's the market situation. Sum up, it's quite an interesting thing, as long as Mr. Draghi, my famous Italian neighbor on Frankfurt East End, will make the quantitative easing of the printing money philosophy, we expect not an end of this capital bubble. Keep it short and simple. He announced every month in his report that he will maybe terminate the quantitative easing by March next year. So just from a purely rational research standpoint, obviously the next 6 months or 7 months he will make it again. And on my personal belief, I think he moved slightly and slowly his role as a currency guy, now become more dominant, important European politician with his policy. And this is again where I see a kind of a Damocles sword, not for our industry in total, but what's goes up must come down. And so the expectations for, please think back on slide number 1. This is interesting in these days, especially in Germany. Again, some boring figures. What happened in the Q2? Meanwhile, we have more transparency on that. The Q2 compared to the Q2s the years before was worse. Worse due to a lot of reasons. The main reasons you all know is the Brexit discussions. And if we dig deeper and see the weeks spending for due diligence and data rooms, especially in Q1 and Q2, you see that they enlarge a little bit. So meanwhile, the average transaction in Germany, average, top 5, face around 11 weeks in a due diligence. Average, of course. This was 1 year before, 9 weeks. So this obviously, I will call it a postponement effect, especially on the Brexit case. But on the other hand, I think looking on the forecast we see for end of this year, there will be a slight reduction, especially in Germany on transaction volumes. But I have to mention this, that we are lacking of all these big portfolio things. So this come rocket up, by the way, maybe at end of this year or after Expo or during Expo on that. So it's the good old days. It's office and retail industry, mixed use, meanwhile, as a new asset class in Germany. Informer, it was the rest. And so you see that especially the first 2 quarters in 2016, it was a reduction compared to these things. I wouldn't quote it all of the Brexit case, of course, but in general speaking, you see it here on the indicators. The prices get slightly higher, so we expect by end of this year, starting from 1st of July now, a reduction of around 10 basis points by end of this year from the average price level. Okay, cross-border investments, I think this is again an important, you know, the Germans, they talk all the time between the A locations, B locations, C locations, D locations. Most of the D locations I've never heard before, but obviously there is a market. But as an analyst, I have to bring this announcement in an Excel sheet and make the sum at the end of the year. There wasn't, the last 5 years, a huge flooding phenomenon into the B and C locations, to be honest. The B activities mainly were driven by the local and regional ones, full stop. I don't see any big British or London pension fund coming to Frankfurt and say, oh, it's so expensive here, let's go then to Magdeburg, Freiburg, and the other ones. I can't really make this measurable, to be honest. On the other hand, I think from a German perspective and from some nearly Germish countries, which is Switzerland and Austria, we see that more activities going now, meanwhile, in the B and so-called C locations. And again, without any big transactions, portfolio deals on that. So cross-border investments decreased, again, the Brexit situation, share of 37 compared to 47 last year. And I mentioned earlier, so we expect an average average yield of 3.9 something for the top ones. And this is again a little bit to be explained. It's Berlin, it's Düsseldorf, Frankfurt, Hamburg, and Munich. And this is, of course, a typical phenomenon from a German perspective. As a lot of Germans are here in the room, we are faced the so-called stability due to the lack of one dominant center. And the dominant center, of course, this is not Berlin. By the way, this is, well, I have to say Frankfurt because I'm sitting in Frankfurt. The Hamburgian guy would say, no, it's Thomas, you're wrong. It's Hamburg, and the Munich guy say nothing and make money. So this is different, but it's a secret, to be honest, that things really get a little bit more stabilized without any dominance. So the volatility is not part of the DNA of the markets in Germany. What we saw the last 12 weeks were a slight increase by Asian investors, which is South Korean ones to Japanese one, and a lot of Chinese investors on the short list, but I can't count the deals because they were kicked out on the short list by the end of the day. Interesting speaking for me, when you heard the rumors and you are involved in these things, they pay, not in average, but obviously they get a higher price, but they don't get the deal. So this is an interesting story, what's going on in Germany. Anyway, I think a little bit on the yield compression, you can see it, and I think all of the researchers faced with this evolution of the gilt or the 10-year treasury bond comparable thing, which is from our expectation, there will be a healthy situation as long as there is 150 basis point difference between Frankfurt and a B location, and this is still in place. So we don't see any overheated situation. I see that a lot of asking let's say prices from local investors who try to sell it to the big fat companies. I understand this for sure, but I don't see any overheating situation coming from Frankfurt to B or C to B locations, to be honest. And so it's in line, to be fair, which means between Frankfurt and Freiburg or between Cologne and Bonn, if there is a difference of, let's say, 100, 150 basis points, then the world, it's okay, and it's a healthy situation compared to our risk models on that. Yeah, you see this, it's a difference between 166 basis point. This was the beginning last year. Now it shrunk a little bit by 249, to be honest. And then again, the commercial transaction volume for the top to the rest of Germany, you see it's reducing, to be honest. But I see this, most of the explanation is kind of a postponement activity, so maybe the expo will be horrible for people who have not an avatar to making parallel appointments with you and myself. So again, the situation, I think it's same wherever you go within Europe and also Germany, and the top locations, the prices get higher, and the B locations or the secondary ones too, but on a minor level. Okay, forget this, but just to work with this later on. Sorry. In the office, I mentioned that the big portfolio transactions are missing right now compared to the last cycle. And this is again, maybe you're faced with the headline yesterday on the resi side with Vonovia, former Deutsche Annington and Convert, and all these things. So we expect, of course, by end of this year, 2 mid-sized, slightly big volume transactions, especially on the resi side, and also on the commercial/office side. You see here. It was the Brookfield one end of last year. Signing was now. The big one in Berlin, and you see, and this is an interesting story, you see a lot of these Berlins here. Berlin, Frankfurt, Berlin. And this is for me interesting because, I have, of course, a home bias. Sitting in Frankfurt and go to Berlin. I know Berlin the last 25, 30 years as a cheap, non-developed city with the government, speaking frankly and open but polite. Meanwhile, things change dramatically. It's fantastic. It's a nirvana for people who have spent a night in a hotel. This is so fantastic, cheap there. Investors react on that. So compared to the rest of the European market, you get the room rate for hotels. It's fantastic. 5-star, whatever. I mentioned this quite simple because the fundamentals of Berlin are based on tourism, and government. And it starts now going on what we call the startup on these fintech things, but on an absolutely minor level. And this, thinking from your perspective and my perspective as investors, is this really, the prices are really risk adjusted on that if the local economy is based on hotel industry / tourism, so why not in governmental things, lobbyists on that. So what is really missing in Berlin, it's what we call the skeleton of a GDP growth on that. I wouldn't be too pessimistic on Berlin, don't get me wrong, it's the biggest country with around, city with around 4 million German inhabitants, a lot of tourists coming up to that. But on the other hand, you have to face that the Frankfurt guys, they're doing something in real estate service and in financial service and all the service industry. The Munich guys, they make something with Siemens and BMW. So each of the top 5, but also top 20, has its own profile. And again, I mentioned this too because the skeleton of the whole industry in Germany is not located in Frankfurt and Munich. These are, of course, the visible big things. The main secret of Germany, it's the so-called, you know the word, it's called the Mittelstand. Mittelstand, I grew up in the Black Forest side, and we have a lot of Mittelstand there with hidden champions, no doubt. Unfortunately, they have not a kind of a culture for real estate activities. So, and you guys and me too would say, don't go to Horb at the Neckar for an investment of 10 million. It sounds nuts. But this reflects around 60% of the whole existing stock in Germany. Bless you. And so think about that. When you heard a story on the hidden champions in Germany, this is the main secret, while it's so anti-volatile, the evolution there. Just to mention this for you. Yeah, expectations and kind of a sum up. Okay, we benefit from the positive economic environment and still historic low interest rates, of course. As an analyst, I have to say we have to be cautious on that, especially looking on Mr. Draghi and his activities. For us, on a short term, it's a positive environment, no doubt. From a long-term view, I have, of course, my doubts if everybody's looking for real estate because it's so cheap, quoting the FAZ this morning. So too much money is sometimes a challenge. Office markets will register increasing take up, and this is again where you see a broad evolution, positively speaking on that. The primaries get higher a little bit. One can quote if some of the 30 euros square meter in Berlin is sustainable, saying this, but it's obviously a part of the market right now. We expect, of course, the further yield compression again by end of this year. I don't see a huge flooding out over to the secondary and third tier locations. If you see these things, then most of them are part of the portfolio transaction and not from Frankfurt to Freiburg. Again, I don't want to destroy your dreams, don't get me wrong, but obviously you are risk managers and our risk managers too say it's strange to make a 100 million deal in Frankfurt and to make 10 million deals in Freiburg and Magdeburg and wherever. This is where the things you have to re-ask your own strategy. So I still believe in the big ones, finally. But again, if there is too much money in the market, we will see what's going on. Okay, investors will move up to the risk curve. For me, interesting speaking, because out of the textbook, we have a new culture in Germany called development. The most risky business ever. But now a lot of companies moved in this sector and, well, to sum up this and make it a little bit simple, they built their own core properties. again in Frankfurt and Munich, whatever. So this is again interesting speaking, coming from the risk adjustment things. Supply demand expected to continue across most prime sectors. You see, I don't talk too much on resi. If you see 10 cranes, 7 cranes are reflected the resi sector, and 3 is something called commercial or mixed use. And this is again, so there is from an analytical standpoint, an absolutely lack of new office buildings. Unfortunately, I have to say most of the local governments, Frankfurt, Munich, wherever, they are a little bit resistant allowing these 100% office buildings. They go more for mixed use and increase pressure on investors to say, and then we have kind of a resi block beside that thing. So mixed use is a really interesting thing, especially for investors. But again, positively speaking, I mentioned earlier strong cross-border activity, especially from the US and Asia. Asia the last 12 weeks, absolutely, starting from 1st of July. And of course, it's the rise of the resi sector, and this will, of course, I guess, the main part of our discussions going.